Well, let's speak to our next guest now. He's Kash Pashootan, Chief Executive Officer of First Avenue Investment Counsel, and a frequent guest on our station. Thanks for coming in.
Thanks, Paul.
So we are very, very nearly at the end of the first half of this year. What is your take on the markets thus far, and what is your call on the remainder of the year?
Really, Paul, two themes stand out to us. One is how narrow market leadership has been in terms of stocks going higher. As we've talked about in the past, you look at the headlines and it suggests that it's been a great year for equity markets, especially the U.S. The S&P, as we know, is up 14-15% year to date, which is an exceptional return 6 months into the year. When you dig a little bit deeper, you see that, unfortunately, that return is very much skewed to a very small handful of stocks. About 7 stocks represent 85% of that return. So many stocks on the S&P 500 are flat to negative this year. And so that is not the sign of a healthy market. And although investors feel enthused about a year-to-date return of 14-15% in the broader market, things can change very quickly if those handful of tech stocks do not keep up the momentum that they've had so far this year.
Okay, let's move to a sector that you do like and I understand are buying on dips in share prices, and that's the U.S. healthcare sector.
Absolutely. You know, investing is about setting your portfolio up for not next quarter, but for the coming 5 years. And when you look at high-quality sectors within, especially a large market like the U.S., healthcare really stands out, primarily because of how it's performed this year compared to the broader market. The S&P, as we said, is up 14-15%. Healthcare is one of the greatest laggards, down 2%. And that's a sector that historically needs to be a big part of a well-balanced portfolio. It's low beta, it's defensive. Generally, you get yield. So there's a lot of positives with that sector, and to be able to chip away at some of the higher quality names when it's down in a year where the market is up is opportunistic.
One thing that's happened is that elective surgeries have increased in volume a great deal since the pandemic, when they were largely not happening at all. What effect has that had on the share prices of some of these companies?
Yeah, so for example, when you look at a company that we own that we do like here, United Health, they would be what's called a HMO, Health Medical Organization. Essentially, think of it as providing health insurance benefits for a monthly fee. That stock's been hurt because of the delay now sort of playing out with post-elective surgeries, because the medical cost ratio, so basically what are they collecting in terms of premium and fees and what are they paying out, that ratio has been skewed to the downside, because with all of those elective surgeries being delayed, they're now starting to really happen. And of course, there's a cost for those surgeries, and the benefits provider, that cost is borne by them. But these types of events are short-term in nature, and we believe that next year, as the backlog of elective surgeries catches up, they will recoup their margins to where they are. So again, if you're taking sort of a 2-3 year perspective, United Health looks attractive because of the pressure that it's faced on its share price with those post-elective surgeries.
You also like CVS. We think of that as a pharmacy store operator because when we travel to the U.S., we see those stores everywhere, but there's a lot more to it than that.
Absolutely, and that's the key. You know, when we think about, for example, Suncor, we always talk about it's integrated, it's involved from A to Z when it comes to the commodity. CVS is similar. It's fully integrated from all the way from the health insurance benefits business that they have, all the way down to the retail pharmacy, which many know. So it's really touching all aspects of the healthcare as it relates to the consumer. And really, it's about a buying opportunity in terms of valuation. This is a stock that has compounded at 10% a year for the last decade. And currently, you're getting an opportunity to buy it at around 8 times multiple, where historically it's traded at around 14 times multiple. So you're getting a 3.5% yield, which is great because, as we know, U.S. stocks tend to not pay the same sort of dividend and yield cash flow that you would get with Canadian names. And it's an opportunity to buy it at much lower valuations than we've seen historically.
Okay, I know you've got some thoughts as well on a completely different sector. That's retailing, and specifically dollar stores. And you prefer our flagship dollar store operator, Dollarama, to some of the publicly traded competitors in the U.S.
Exactly. So the U.S., unfortunately or fortunately, depending on how you look at it, provides better growth opportunities than Canada in a variety of industries, but the dollar store model, not so much so. And it's a variety of reasons. Number one, there's a lot more competition in the U.S., so there's 2 large players in the dollar store in the U.S., only 1 in Canada, and then there's also several mid-size. So from a competition landscape perspective, much more dominance from a dollar store perspective here in Canada. The other side of it is, what's the product lineup? So the dollar store model in Canada is much more simple, I would say. For example, there's no fresh foods. You don't need coolers, freezers. So their overall floor plate and CapEx spend is quite a bit lower than what the model looks like in the U.S. So that, combined with competition, does provide considerably more benefit. And you see that in the operating margin. So in Canada, the dollar store is operating with a greater than 20% operating margin, where in the United States, it's about 10%. So competition, less CapEx, results in higher operating margin, and that's the driver to why we see more opportunity in Canada compared to the US. We've held both in the past, but currently we just own dollar store in Canada.